Thank you, JJ.
Everybody, Ms. Lopez.
Hi, guys. I close a lot of these loans. I use a lot of different lenders. However, I do have a handful of lenders that I like to work with. Something that you guys might not know is every DSCR lender has a different set of guidelines. You know, I've got a lender that has no minimum loan amount. I have 3-month cash out seasoning. We'll touch a little bit about that, but that's just something for you guys to be aware of when you're talking to each lender that might not be the same set of guidelines. Personal note, I have 2 kids that live with me full time. They are here, they're somewhere out there though in the car. And I love health and fitness, that's my passion. So yeah, let's get on in the heart of this. Some common misconceptions with DSCR loans. Non-recourse. Everybody thinks these are non-recourse loans. That is incorrect. You are personally guaranteeing these loans with the majority of my lenders. I want to make sure you guys are aware of that. We can close in LLC. Majority of the lenders allow you to close in LLC, or all of them except for one of mine. Most of the lenders are not going to report the loan to your personal credit report. Some of them do. So if that's something that you guys don't want, make sure you're telling your loan officer you don't want it reporting your personal credit report. So you are personally guaranteeing. So if you don't make those payments, the lenders can eventually come after you guys. Just want you guys to know that. They are recourse loans, the 1 to 4 units. When we get to the 5+, that's a little different ballgame. Credit requirements. So yeah, a lot of investors think, well, it's based off of the asset. There's no credit, right? Incorrect. All my lenders are going to require a credit pull. Majority of them, 99% require a hard pull. Hard pull is good for 90 to 120 days, depending on the lender. We only need 1 hard pull with multiple properties. So you could do multiple properties, just use that 1 credit report. I do have 1 lender that does a soft pull, or a couple lenders that do a soft pull. Those lenders do take a little bit longer. So like I mentioned initially, every lender's got a different set of guidelines. They all have a different speed. So if you guys are trying to get your loans done fast, you want to make sure you go to a lender that's going to get it done fast. Some of these lenders, it's like pulling teeth trying to get these loans done. If you guys have ever done a DSCR loan, sometimes it could take 2-3 months. You know, dealing with these lenders and the underwriters on the back end, it's like they're doing everything they can to not get these loans through. There's other lenders, though, that are super fast, and we can get them done super fast. So, down payment requirements. People always think, can I buy a DSCR loan with no money down? Incorrect. You always have to have skin in the game when you're getting a mortgage. Typical down payment requirement is going to be 20%. We can do 15%. When you're doing 15% down, you are going to have a higher interest rate. You can get seller credit and ask to buy that interest rate down. Then you can get in with 15% and have an 80% rate because you're buying that rate down. I do have 1 lender with 10% down, my only creative lender that allows a second lien position. For those of us in sub 2, everybody comes to me about Morby methods. Can we do a second lien position on these loans? We'll talk about Morby methods a little later. They wanted me to talk about weird DSCR scenarios, but we'll touch on that creative lender in a little while when we talk about the Morby methods. Secondary financing. Like Brian had mentioned earlier, lenders don't allow second lien positions. Investors are always coming to me wanting to use somebody else's money. We'll put a second lien on. I want no down payment. Not going to happen. Talk about some of the DSCR requirements that are the guidelines that are different with some of the lenders. Minimum loan amount. I have 1 lender with no minimum loan amount. All those Midwest properties, I can get you guys financed. Other than that, we start at $50,000, $75,000. Most are going to be at $100,000 for the DSCR lenders and their minimum loan amounts. Credit flexibility. I can go down to 600 on the credit score. Now keep in mind, lower credit scores, higher interest rate, you're not going to get your max financing. We're not going to get max LTV. I could still get you financed. I actually have 1 lender that has no FICO requirement, but you only get 50% LTV. But if you have a 500 credit score, I can still get you financed, but you got to have 50% down. Most of the lenders are going to be at like 680, 700. For an over 700, 720 is going to get your best pricing. Anything over 780 credit score and above, you guys are going to get the same interest rate, just so you guys are aware of that. Cash out options. I mentioned earlier that I have some lenders that could do 3-month cash out seasoning. What does that mean? If you buy the property, all of these lenders have a time period that you have to wait before you can take additional equity out of the property, meaning you do a cash out refinance. All lenders have a seasoning requirement. Most of them are going to be at 6 months ownership. So you're foreign national.
Yeah.
Yes, I can get you done. Certain lenders, you are going to be LTV restricted. So when we're a foreign national, 65-75% LTV on a purchase, cash out, 65-70, so it's depending on the lender. But yes, we can get you done. If you live abroad, you have no credit score, you don't even own a house here, we can still get you financed. Any other questions at this time?
VA loan.
VA loans? What about VA loans?
Can you do VA loans? So you go through the VA process?
Can I personally do VA loans?
Yeah.
Yes. I'm a licensed loan officer. I can finance DSCR nationwide. I can finance conventional, FHA, and VA in 14 states that I'm licensed in. I love veterans. Are you a veteran? Thank you for your service. Any other questions right now? All right, let's move on. Co-living and pad splits. Everybody comes to me all the time wanting to talk about co-living and pad splits. That's the big thing, right? It's the wave of the future. You know, everybody's housing is going crazy, especially out here. So I have got 2 lenders that will finance co-living and pad splits if they're actually co-living and pad splits now. So one lender on a purchase, we're going to be looking at your long-term rents. So even though it is a pad split and co-living and you're collecting more income on that purchase, they're still going to be qualifying off of that long-term market rent. We're going to get that 1007 market rent form. That's what it's going to tell us the market rent is. So if your property can qualify using long-term rental, we're good to go with that one lender. My other lender uses 12 months of income. So if you own a pad split, co-living for 12 months, we can get you financed using your past 12 months income. Pad split is going to be rent by the room. Could be long-term, could be short-term, typically it's rent by the room. Which most lenders, you go to a lender, they're not even going to know what a pad split is. I talk to my lenders, they don't know what a pad split is. I'm hoping that changes in the future. So, pad splits, it depends if you guys convert them or not, how we're going to look at the financing. Because then you can go to pretty much any lender to get finance versus, 2 to 3 lenders that are out there. You guys have questions on pad splits? Co-living? And generally, LTV on a purchase is going to be limited. So we're going to be 75% on a purchase, and then cash out 70. So you're going to be a little bit lower on the LTV when it is pad split co-living. Assisted living and sober living. These are going to determine, are we looking at this as a residential property or a commercial property? If you're taking a single family home and you're going to convert it into an assisted living or sober living, let's finance it on a DSCR, a regular DSCR loan when you're buying it. And like I mentioned, however you're going to run it later, if you can change the model. However, a lot of you guys come to me wanting to look at these as let's just look at the business income. We don't want to look at it from a DSCR rent perspective. We can also look at the ADU. What is that going to bring in? Do you have a lease on that ADU? Do you have a lease on the single family? That is also going to make a difference. We have comps. So comps in the area is going to be big. You want to make sure if you're putting in ADU that you have other properties in the area that are going to have ADUs, or you guys are not going to get the value that you're looking for. And multiple structures. So I've had people come to me, I've got a duplex and a single family and 2 single families, and they're all on the same plot. They're on one plot of land, one parcel. We can look at those as multi-unit properties. So if you got, say you got 3 single families that are all on the same parcel, we can look at it as a 3-unit property under DSCR with certain lenders. Morby method. All right, this is the big one. So what is a Morby method? Morby method is taught to use the seller to help finance your down payment. That's how they teach us in the sub-2 community. There's all different ways that they teach people how to do the Morby method, but the right way to do it with the lenders is come to me with my one lender that'll let you record, he'll let you record both liens at closing. So we'll record the first lien, we'll record the second lien, you guys make up whatever terms you want with the seller, and both those liens are recorded at closing. That lender will lend 75% loan to value on the first lien. You bring 10% down. This is my only 10% lender. And then you can get your seller or private money lender to finance second lien position, 15% or higher. Less down payment. It is a higher interest rate. That rate is typically 8 to 9%. But if you guys can get seller or private money lender to be in second lien position, it's a great deal. Say you got a crappy credit score. You're working on your credit score, but your partner has really good credit. Your partner's in your LLC. We can do the loan under your partner's credit, and you can leave you off the loan, but you're still an owner of the house. Even if they're not your partner and you just want to find somebody to help you get into this loan, you can add them to your LLC, and we can do the loan under their credit. Same with the private money partner. So you need funds for your down payment, you add them to your LLC, you're okay with them being an owner, partial owner, the money can come from their bank account. It's a legitimate way to get those done. Do you guys have any questions on the Morby methods? Yep, so the second lien position, it could be as much as you want, but the minimum loan amount is $75,000. So you just can't go below that with the first lien. But say you wanted the seller or the private money lender wanted to finance 20%. Then the first lien would only be 70. 70 on the first lien, 20% second, you're 10% down. You're always gonna have to bring 10% down. That's something people ask me, well, can they just finance my down payment? No. Lenders always want skin in the game, but
are they sourcing it?
They are not sourcing it.
You don't have to go through any hoops that you're jumping of where that 10% showed up from your...
Needs to be in your business bank account.
Okay.
As long as it's in that business bank account a couple weeks before closing, doesn't matter if it's a large deposit, they're not going to ask where it came from.
Okay, thank you.
Yeah, they're very lenient. I can talk to you about a lender perspective.
Okay.
We could talk about that too, assignment contracts. My lenders most of my lenders will allow an assignment contract. There is a maximum fee depending on the lender. You guys might say, what is an assignment contract? So if you're a wholesaler, you find a house, you find a buyer, you're assigning that contract to your end buyer. So generally there's going to be an A to B contract, and then there's going to be a B to C contract. Your lender needs both of those contracts. You have to disclose that up front to your lender because they're going to see that. You can't just give them your B to C contract because the seller on that is not going to be the seller who's listed under the vesting of that home. You're going to have to supply those two contracts to your lender. Make sure they allow assignments. And as long as your max fee, it's not exceeding, you're good to go. We can also do it as a double close. Lenders will allow double closes if they have a guideline, 1 day seasoning for the seller. Some lenders have a 90-day seasoning for your seller. You can't do a double close. You're gonna close the first transaction, you're gonna try and do the second, and the underwriter's gonna say, they've only been in title 1 day. We're not doing that loan. That's why you wanna make sure when you're talking to your loan officers, please disclose everything. I always tell people, just be honest with me. I'll guide you guys through, we'll go to the right lender, but I know most of the guidelines for most of these lenders. I've run into the roadblocks before. You know, this business is not an easy business, whether it's real estate or it's mortgage. You're gonna run into things, we make mistakes, we learn, we get back up and we keep going. I have stories to tell you guys about, they were talking about their real estate journey. I mean, my first go around, I lost $350,000 flipping homes in Houston. There's no GC licensing requirements out there, you gotta watch out. So, you know, it was a hard pill to swallow. You guys just gotta get back up. I took some time off and went right back at it, found Pace Morby, and now I found this amazing community, and And I kept going. So yes, but to answer your question, we could do double closes. Only depends on the lender. You just want to make sure they have that underwriting guideline, 1-day seasoning for your seller.
Let's say you want to hide that from the bank, so you're not actually going to take the title and put it out there. So it's what do you call it? It's in escrow, and it's not actually registering to the bank, so you don't have that due on sale clause. So
What do you mean by that?
what I'm trying to say is,
How are you not registering with the bank? I'm not understanding that.
well, I'm trying to figure out being able to hide it from the bank itself. So,
What are you hiding?
the actual transfer of the title, of the deed itself.
Like, walk me through it.
Okay, so when you're doing a subject to, you keep it in the seller's name. All right, you're not wanting to activate that due on sale clause, all right, by keeping it
Trust.
hidden. Okay, a trust.
That's really the only way.
Sell your LLC, is that right?
You could do that. Yeah, because the operating agreement is not recorded and filed. Operating agreements can be changed at any time, and they're not recorded and filed anywhere, as of right now. So nobody's going to know, and especially if it's in Wyoming. Nobody's going to pull up the ownership in Wyoming, right? So that, yeah, LLC transfer, putting it in a trust. Otherwise, I can't advise you. There's some things that I can't really talk to too much, especially on camera. Yes, yeah, anytime you change transfer of ownership, you're vesting on your title, you can get the due on sale clause. I've been in the business 20 years. I've never personally had anybody come to me and tell me that it's happened to them. I know it happens. If you're making your payments on time, banks aren't really in there to try and figure out, did you change titles? If there's no red flags, you're making your payments on time, I don't know if the due on sale clause will be called, but it's always a chance, right? There's always a risk. If I have one underlying mortgage late, we're okay. 2 mortgage lates in the last 12 months, I could probably get you done. 3 mortgage lates, now we're going on a bailout loan. We're going into foreclosure. Lenders are not going to finance you if you are in a foreclosure or bailout situation. So yeah, one of my great pieces of advice to you guys is keep making those payments until you get out of that financing. Property condition. When an appraiser appraises your house, there's a condition rating on there, C1 through C6. These are rent-ready loans for rent-ready properties. If you need renovations on that house, if it's a dilapidated house, health and safety issues, we're not going to be able to finance you. Condition rating needs to be a C1 through a C4 in order to get DSCR financing. So you need renovation funds, let's get you in a hard money loan, and then we'll get you to a DSCR loan. So yeah, condition rating, the value, the value of the property is always going to matter, and then the market rent. We can do as much diligence up front to estimate what the market rent is, but ultimately it's going to be up to the appraiser to come back to us and tell us what they think the market rent is. Now, say the market rent comes back at $1,000, but you've got a lease agreement for $1,200, $1,300. With some of these lenders, we can use that lease agreement. Say it's a new lease. Some of these lenders will let us use a new lease with first month's rent, security deposit. Some of them want consecutive payments. Some of them want 3 months. But we can still use that with certain lenders. There are other lenders that are going to use the lower of the two. So if you guys are in this situation, you want to make sure we're going to a lender that's going to let us use your lease agreement over that market rent. But that is also another reason that loans can get declined. We can still do these loans if it's under that 1 ratio. What does that 1 ratio mean? If your rent is $1,000, your mortgage payment is $1,000, and that's your all-in mortgage. Principal, interest, taxes, insurance, HOA, flood, that's your full payment. If they both equal $1,000, that's a 1-to-1 ratio. If your market rent is under that 1 ratio, we can still get you financed. When you're under that 1 ratio, you're going to have higher interest rate. You're going to be limited on your LTV, so you're not going to get as much on your loan to value. We can still get you done. Why would somebody want to buy a property that's not cash flowing? Well, maybe you guys just want to get in. You might do some, I don't know, some type of different marketing or put a little bit of renovations in, and you're gonna get more, you know you're gonna get more market rent in the future. You just wanna get in the property and get it. So just keep that in mind. If that is something that you guys are dealing with, you may wanna disclose that so your loan officer knows to send you that right lender. Most of the lenders aren't gonna care. They're not even gonna pull up your history. Now let me see if there's anything I missed here. Oh yeah, prepayment penalties. I want you guys to be aware that these loans are generally gonna be priced with prepayment penalties. What is a prepayment penalty? That means if you sell or refinance the house within that time period, you're gonna be paying a fee. Typical prepayment penalty, 3-year step down. What does that mean? First year, you pay 3% of the outstanding balance. Second year, 2%. Third year, 1%. If you sell or refi, you're gonna have to pay that fee. Prepayment penalties are we can change them. Just because the lender comes back and says, this is your pricing with 3-year prepay, you don't have to take that 3-year prepay. You want a 1-year? Tell them. You want a 1-year prepay. Most of these loan officers, they just give you that 3-year and you move on. What do you guys want to do with your property? Do you want to hold it for a long time? Are you going to be selling it next year? That's going to make a difference of how we price your loan, what type of prepayment penalty we're going to use. You know, there's different ways that we could price these loans. Correct. Once that time period is over, it does not apply anymore.
What's the typical time period?
3 or 5 year are the typical prepayment penalties. 3 or 5 years. Typical step down, but some of them are going to be fixed, meaning it's a fixed percentage every year.
Okay.
Yeah, you're welcome. Yes. Yeah. When it comes to mortgages, we lend on the lower of the value or the purchase price. So if your purchase price is $100,000, the appraisal comes back at $120,000, we're loaning you on $100,000. If your purchase price is $100,000, your value comes in at $80,000, you're gonna have to renegotiate, ask that seller to lower the purchase price down to $80,000, or you're gonna have to bring in that extra $20,000. Because from a mortgage perspective, we're using that $80,000 to lend. That's your purchase price. Correct. Yes, so the lender has to have an underwriting guideline that says 1 day seasoning for the seller, meaning they only have to be in title 1 day. That's in their underwriting guidelines. Most other lenders have 90-day seasonings, saying the seller has to be in title for 90 days before you could they can sell it and you could do a DSCR loan. I don't teach it like PACE. I teach it from a mortgage perspective, from the legal way. I'm just, you know, I'm gonna be careful with my words, but yeah, PACE does teach that no money out of pocket. That from a mortgage perspective, there are no loans that you can get 100% financing on. I know that he teaches different ways. Put your seller in your LLC, which it's a fraudulent transaction. Your seller can't be the seller and they can't be the buyer. And an underwriter, a good underwriter, or as a former underwriter, they're gonna see that. They're gonna read that LLC documentation. They're gonna see that the seller is an owner of that LLC. I don't know all the ways that it's taught, the Morby method, but I can just tell you the right way from a mortgage perspective. And I only have one lender that allows it. So if you guys are gonna put second liens on after closing and all that other stuff, honestly, I don't wanna know about it if you're coming to me. I'm a licensed loan officer. So, I mean, like I said, disclose it, I'll instruct you, but if we go through the transaction, I don't wanna know if you guys are doing stuff like that. But I can get you done. We can do it at the same time and record both liens at closing. That's really the only answer I can give you for that one.